Welcome to another Impact Insights. I'm delighted to have with me today Robert Sinclair, Chief Executive of the Association of Mortgage Intermediaries. Hi, Robert, and thank you for your time.
Pleasure, Dale. Good to be here.
Now, we've worked together a while, and I'm very honoured to sit on the Association of Mortgage Intermediaries Industry Contact Group, which you run every other month, which is brilliant and a really good insight for us. But for those people who don't know much about AMI or what you do, can you just give us a quick insight, please, onto the background and the hard work that you do behind the scenes?
Okay, the Association of Mortgage Intermediaries is really the trade body that protects the commercial interests of firms against what government and regulators may be trying to do to interfere in the marketplace. So my job as Chief Executive is to manage the team and manage the messages that member firms want us to take to regulators and industry, and monitor what's happening out there with the regulator and Treasury, Ministry for Housing, Communities, Local Government, to see what they're bringing to the marketplace and to influence all of that in order to make sure it works best for the industry, for consumers, and for government itself and regulators, in order to be a bridge of information and knowledge. And we do that by really trying to understand and explain that to as many people as we can about what we think the potential impacts might be, and therefore try to make sure that when any change is implemented, it's as practical as possible so the industry can work with it. And that's kind of the job. Our job is really to make sure that firms can be here tomorrow still making money, and that profit shouldn't be a dirty word.
Yeah, absolutely. I think more being here tomorrow, I think, is more crucial in the current climates. So what's your average sort of day consist of? How many, who are you talking to? What's sort of the timescales involved in these sort of things?
Well, everybody's world has turned upside down in the last 7-8 months, and mine's been no different, in that I used to spend a lot of time traveling to the office of Milton Keynes, into London, around other parts of the country, being at industry events a lot of the time, and all of that, of course, has gone by the board. So my day tends to start nowadays at 7 o'clock on my laptop. I get up at the same time I always used to get up and start work then, and it's almost depends what the world brings me each day. But we do have a team meeting every day at 10 o'clock. So the 4 or 5 of us get together every morning at 10 o'clock and look at the current work issues, what's going on, feedback to each other on what we've been doing the previous 24 hours, and planning ahead for what we need to do in the coming weeks and months to ensure delivery of the things that are going on. So we've got, even now, we've just actually in the last 3 weeks responded to 4 active consultations from the FCA. We've got a series of consultations ongoing between now and the end of the year with Treasury, MHCLG, and FCA. We tend not to worry about prudential regulatory stuff too much, because that's more about lenders themselves. But what we're continually trying to do each day is also talk to members as much as we can by way of member meetings, one-to-one dialogues, talking to lenders as well about what they're doing in order to understand the issues that they're facing and try to encourage them to do things that are better for the intermediary sector. So it's a mismatch of meetings, discussions, debate, and actually it's a weird thing in that in this job, the more time you spend talking to people, the more you begin to, I use the phrase squaring circles. You actually begin to understand more and more, and therefore all the discussions you have lead to further discussions and further discussions.
Of course.
And sometimes it's also about talking to people about products they're trying to bring to market as well, in the same way that you will get involved with people trying to innovate and bring things to market. We have the same conversations as they're trying to work out whether, and putting them in contact with the right people sometimes about who they might want to talk to about their new proposition to get it to the market in the right place. There's lots of things happening at the moment.
Yeah, no, it's really good. It's really insightful. I think the biggest thing for me at the moment is obviously lenders are really putting it out there to try and get volume business in and maybe catch up from the 6 months that they were unable to do the levels they were looking at. But of course, on the counteracting side of that, obviously we're seeing a massive impact in service levels at the moment. Is that coming across your desk? Are you involved with lenders? Are they looking to see what they can do to help out on that basis?
I think everybody knows there are perhaps 2 or 3 lenders who are really not in the game at the moment, and a couple of them are really big lenders. And that's putting significant pressure on the rest of the lender community, as the volume that would have gone to them traditionally is going to other places. And I can see data that tells me that we're going to end up, I think, in terms of 2020, completing more property transactions than in 2019. So that's more purchase transactions, either new build or second hand. And that, with 3 months where the market was closed, means that for the other 9 months we've been running really fast, and the market is really probably running a little bit hot at the moment.
Yeah.
Remortgage and product transfer hasn't gone away either. So, and the buy-to-let market is probably better than it's been for some time in terms of both purchase and remortgage. Therefore, everybody is very busy, and I think service levels have struggled because of that. Because not only of lenders struggling because there's probably more coming in the door than they expected. But they're also having to work with staff working from home environments, remote working, which isn't helpful. I mean, and one of the big issues that I know that the conveyancing world has is that if they're in the office, they've got 2 screens in front of them and great system connectivity. Working from home, they've probably got 1 laptop with 1 screen, and therefore to jump between screens. Therefore, that reduces their personal productivity by about 30%. Never mind the fact that remote working also reduces productivity to a degree.
And you've also got the kids running around in the background and the dog barking and so on and so on. But I mean, this is the way forward, isn't it? This is the way it's going to be for a little while. And you know, the key things with regarding to ID for clients and client meetings and advice and so on and so on. You know, brokers have had to adapt, and you know, we live our lives on blooming Zoom. But at the same time, it means also that I'm not having to do a 2-hour journey to go and see somebody, to have an hour and a half, 2-hour meeting, and then 2-hour journey back. So I'm actually getting a lot more done during the day. But going back to the advice bit, if you're seeing a client on Zoom and the identity and so on, is that feasible moving forward? Are lenders going to accept that?
I think the world is in a particular place at the moment, and I worry about some big firms who are already making kind of statements about this is going to become the new normal. We're going to have lots more people working from home and moving away from office work environments, because I don't think that's what actually motivates people in the long term. In the short term, this has been a pleasant change for some people in a different working environment from the one they had. But I'm not sure how you build connectivity and teams and empathy and all the understanding. I'm not sure you train using this environment in the same way either, because a lot of what we've always done in this industry, and it's not the right phrase, but sitting with Nelly, you learn by sitting with somebody else and them teaching you and coaching you, and you learn the job from somebody else beside you. How you learn in this environment, where the only learning might be through remote learning, is a very different thing. And I'm not sure you build the right culture in a firm, or you can build culture in the same way that you would want in order to make sure things will be done the way that you want it done. So I worry about some of that. But yes, I think some of the customer interaction stuff can certainly be done this way for more of the future. But I think we've got to be very careful that we don't put ourselves in a corner and don't actually remember why customers actually liked sitting in front of us to begin with, and we didn't use this approach. Because I think as we've migrated towards this, we will see a pushback from people at some stage in the future to say, well, actually, you know, I actually want to sit down with somebody again and have a proper discussion. That's different from this is very kind of one-dimensional, because you don't get the depth and the texture in the same way. And I know that I've been listening to some fairly senior people running big boards of companies and big management teams, where they're saying they want to go back to face-to-face because they can't really get the feel of all of the things that are going on in a dynamic of a discussion, where they don't get that same feel of the sense in the room when it's on a Zoom call as opposed to when they're in a room together.
Yeah, or the fact that they're wearing a shirt and jacket and then shorts and underneath and whatever else when they're sitting at home. Not that I am, because I'm in the office, obviously. Do you think also, I mean, this is obviously ongoing for a while. Do you think this also going to affect the way we have client retentions and product transfers, and again, where maybe a broker might have gone out and actually seen someone face-to-face in their house, actually now obviously Zoom, not everybody uses Zoom and so on. Do you think that would be affected?
I think where you've got an existing relationship with a client and you can use technology like this to have that interaction to do the remortgaging product transfer, that's great. I mean, I think that's where it really works well, once you've got an established relationship. And I think that's part of our industry, in that we're all probably working predominantly within established relationships, and therefore this technology works. If you're trying to create relationships in this environment, it's not as easy, which is why I'm still going into London for occasional meetings, because there are some new people I want to meet and have a proper discussion with. They're on another way. But I do think that the firms that win will work out how best to use technology to their best advantage, and still think about how they work with other consumers who want the face-to-face or that more personal feel of touch to the relationship. And I think it's not being one or the other. It's about how we become everything for everybody and staying in that space of being adaptable.
Sure. Okay, well, let's move on to some of the concerns in the current marketplace. What should brokers be concerned about? And obviously, one of the bigger ones at the moment is obviously senior managers regime that's coming into play. How is that transpiring with obviously the COVID delaying things?
Yeah, I mean, the regulator has, well, the senior management regime piece is effectively done. It's the certification regime and the directory that comes next. And I like to keep those two separate things. So the certification regime was meant to be done by the 9th of December. The FCA is now, and Treasury have given permission for that to be extended to the end of March. So people now have longer to get all of their employees who need to be certified through that certification process. And we'll also beginning to get instruction from the regulator in the next few weeks, I think, about how we input all of the people who need to be added to the directory, i.e. the bit that sits below the FCA's register, all the people who have to have an exam qualification to do their job, how they all go into that directory in order to, so that consumers can see all people who are authorized by firms or permitted by firms to do regulated activity. So that's ongoing now until the end of March, and we have now till the end of March for all staff to be trained in the conduct rules as well. So that's work for firms to do to get themselves through the system in terms of all of that. So
sure.
Bit more time because they felt we'd lost 3 months, so we get an extra 3 months to sort it out.
Okay, and the other bit that keeps hitting my desk at the moment is obviously ambulance chasers and subject data access requests and bits, and I noticed happening all across the industry. Are brokers doing enough to cover their backs, making sure that they cover all the compliance and the regulation and bits? And is there already too much paperwork in the industry? Are we looking at bringing more in to make sure that, you know, the poor client is filling out 50 pages rather than 20 pages to make sure that we cover our backs on that basis?
I think the problem of compliance and that being a ticket to the game is never going to go away, and the need to justify the advice that's been given is just part of the industry that we operate in, because of the nature of actually what we do with people is we have a great deal of knowledge about the marketplace and what goes on. They don't tend to have that same level of knowledge, so that what's called information asymmetry is really important, that we get right. The fact that we properly fact find, properly assess people's needs, and properly make the right recommendation of the solution for them. And the regulators have always been fairly clear about that. What I do worry about is how we worry about some of what I call the trivial details sometimes to make it more important than it possibly is. And I think that when you actually get down to conversations with customers, it's very much about what are the key things that are really worrying you and concerning you, and making sure those are documented. What is the things that are driving the decision that you're wanting to make here, and getting those documented in a very clear way. All the information about their name, address, and telephone number and how many children, does it really matter? Because it's about what it is they're thinking and feeling at a point in time that justifies the advice that's been given, and making sure that's recorded in a document that becomes part of the permanent file and played back to them in form of a suitability letter, which still isn't mandatory in the mortgage market, but a good way of playing it back to them to say, this is what you told me and this is why we've done what we've done. And I do fundamentally believe that any supervisor that comes out and looks at anything and sees that level of quality of substance of this is what you said, this is why we've done this, is exactly what they're looking for. We lose sight of that sometimes at our peril because we're worried about all the other information that we need to get the application through with the lender or to satisfy our own compliance department sometimes. But that should not be the core dynamic, because it is about what is it the customer said that made you think that's the right answer for me? And it's hard because there's always competing pressures around this. And we see it now with all the cases from a firm called Pure Legal who are chasing down interest only. And there's no reason for them to chase down interest only. Interest only has never been a toxic product. When the FSA did all their previous work at the end of last year, at the end of the last decade, they came out and said, look, the lenders need to start writing to customers on a regular basis, but we're not saying this is a bad product. There's no remediation required. It's just get people aware of the issue about having to repay the capital at the end. That was the only issue they said that was there, which is fine. And you know, we're in a situation today where we've got thousands of potential claims sitting out there from claims managers and legal firms on interest-only cases. At the same time, the regulator is saying to lenders, it's absolutely okay to have people who are in financial difficulty and vulnerable put onto interest only for a period of time in order to get them through the problem. How can that be a toxic product when we're using it with regulatory permission at this point in a curve? It's crazy.
Yeah. I'm just concerned about the amount that it's happening, and also the amount of time and investigation it's taking on behalf of brokers, packages, networks, then lenders maybe as well.
What I can assure you is that Amy is very active in talking to the FCA and to the Solicitors Regulatory Authority about all of that and the issues of it. So it's hard to be positive about it, but I am aware that it looks as though some of the cases that were with the Ombudsman look as though they're going to be time barred now. And that's a really positive thing there, because I do believe all of those issues have been around for so long that in 2012, Martin Wheatley made it very clear there was no case to answer here, and that there was everybody had to be written to be told. That means now we're past 6 years past that date. How can there be an issue that should not have been dealt with by a consumer by now, because they've had successive letters when they should have known if they might have an issue, and they're 3 years past that date, never mind 6.
Yeah, okay, that's good, that's positive. So what are the FCA, in your eyes, getting right at the moment, and what they may not be getting? What are they actually getting wrong? I wouldn't say wrong, but not as good as they could be, maybe.
The thing that you've known for a long time, Dale, I've always said that I think the FCA is a very, very good regulator, but I worry about how good they are as a supervisor, because I think the way they create rules and regulations for which we all have to operate under, they're really good at that and consult very well, and they are gold standard in terms of how they consult with the industry most of the time. In the competition world, they've always got that a little bit wrong, and I always think in the competition study on mortgages, they got so much of that so wrong in terms of the way they both analysed the data and the conclusions they came to at the back end of that. And I still worry about that, in that we're about to go into a consultation with them around what they want to do about the 20% of people who revert onto SVR at the end of an incentive period and don't move from it. Yeah. But we know from that there's a whole host of reasons why that can be, which can be low balances, short-term left to completion, people who are actually just happy to be on the SVR and don't want to go through the pain of going through another proving of affordability again or anything like that. So there's lots of reasons why it happens. And often it's because people have come off a higher rate onto an SVR that's less than they were paying. So they actually think they're better off and quite happy. So although they could still save some more money, they don't want to go through the pain. But we're going through a consultation on that, I think, around December. And Amy's just done a piece of work to try to work out what best practice in the marketplace could be to help influence their thinking around some of that. I do think that the piece of work they did around the later life market around the year was actually very good. And I do worry that people have lost sight of what was genuinely meant within all of that. So in my view, everybody's gone back into, oh, well, it's not quite right because we need holistic advice. We need to layer more in. We need more checking. We need more things on checklists. No, the fundamental that sat in that was a customer comes to you with a problem that says, I need to make a decision about how I deal with a borrowing requirement into later life. There was over-reliance in all of that on the 4 eyes check of the solicitors as to whether there was undue influence or any family influence, or why they were asking for the money. The documentation up front of, as I was talking about earlier on, what was the purpose? Why did the customer want this? What was their motivation? And having that clearly documented was not there in the files. All they could see was somebody turned up in response to a TV advert, wanted equity release, got equity release, and walked out the back end of it with the check being done by a solicitor without adequate evidence in the customer file as to why they wanted the money and what they were going to do with it. And that is still the gap that I think too many people in that sector haven't got their head round in terms of the what and why and how.
Okay.
Just one last bit. The FCA will continue to be difficult because the mortgage market and the related markets are always some of the biggest financial transactions that people enter into. Pensions and savings are another end of that, but mortgages are probably the biggest single item that comes across their personal profit loss and balance sheet. And therefore, there's always going to be a great deal of focus and interest on that because of that. And I think, I characterize the fact, I've been talking about it in some other meetings that I've been having with the FCA recently about this, where there's a lot of concern on the investment side of the marketplace about the cost of the compensation scheme and the hundreds of millions that are going out to pay for pension mis-selling and unregulated products in pensions. And the interesting part of that for me is that following the crisis in 2007, the mortgage market lost about 20,000 advisors. There were about 30,000 advisors out there in 2006. That was decimated to 10,000 by the time we reached about 2010. And it's gradually grown back up. But during all of that period from 10 through to 16 as it was growing, we also lost about 1,500 advisors where the lenders decided to clean house and take them off panel because they felt that they weren't doing the job well enough. And this segment of the market has done an awful lot to professionalize how it operates. And it really has genuinely professionalized, I think, an enormously long way in the way that we bring customers in, the way that we treat them, the systems we now use, the background systems we've got to take the customer through the journey have moved a long way forwards from anywhere else that sits the investment side of the marketplace. And also the fact that we tend to root out what we think is not good enough by way of products or services from providers in a way that I don't think the rest of the financial services industry does. I think there's a lot of lessons that could be learned by the rest of financial services from what they see in the mortgage industry. But they always see this sector as the lower end of the food chain. And I think there's a lot to be learned from what's happened in the mortgage industry over the last decade.
Yeah, no, I agree, definitely. What about cheapest product? And the more recent,
it couldn't be hard at the moment, given the servicing problems there are at the moment. Trying to have to also work out why somebody may not have got the cheapest product under that cheapest product rule is just it's a nightmare for every broker that I understand at the moment. It was a stupid idea when it was going to be introduced. We said it was a stupid idea the way they were wanting to introduce it. Unfortunately, when they got 42 responses to the consultation, there was only one response that really ripped apart the cheapest rule, and it was us. And on the 41 didn't comment on it and one objected to it, they just decided to implement it in the way it was implemented. And that's because in that consultation, there was lots of other things that were much more emotive and people were focusing on in terms of particularly around execution only and interaction rules, because that was part of the same consultation group.
Yeah.
And therefore, that cheapest rule kind of got through. And the way that has to be calculated by way of the equation or the rules that are in there is just a ridiculous structure. So Amy's done some work to try to help people understand that, but people should genuinely understand in there that all the rest of suitability should come first. So the right term, the right product, the right structure with the right lender and the right lender for the right reasons, which could be just sheer convenience or yes, guaranteed approval.
Yeah.
It's something that can go into that whole equation before you have to get the cheapest rule. And it really is the back end check, not one of the front end ones.
Yeah, absolutely. And I think we're also up against it because in the current climates with properties being sold, they're being sold to 3 or 4 people, not just one. And whoever gets that mortgage offer out the quickest tends to be the one that wins. So that's a whole other rant, I think. But what about you mentioned technology going in the right direction, or has it just been a lot of hot air over the last couple of years? And is it actually becoming beneficial to the end broker and even the consumer at the moment?
There's been a lot of noise around technology in this industry for quite some time, and certainly when we reached the point where we had brokers coming to the market saying they would revolutionise it and automate the whole thing, I laughed. And I think the way those firms have had to move over the last 4 or 5 years kind of indicates that you do need people in the process somewhere. But what we are seeing is lots of disruptors and interrupters playing about with technology, and that's good because that challenges the norm and makes us think about how we do the job and thinks about how we can simplify and make it more productive and take the costs down in the longer term. And that's the right place for it to be. And what I think we are seeing, though, is that there are a range of firms who are absorbing parts of that technology into a much longer journey. Because I think what everybody genuinely wants in this marketplace is the simplicity of how do I capture electronically as much data as I can about my customer that's going to be used further down the line. How do I use that to supplement the thinking process and the advice process? And how do I use all that data to squirt it out the back end to wherever I want it to go? That's a lender or insurer or a conveyancer or a valuer, so that all of that data can squirt out the back end to the right places through the right interfaces. And using technology to make that journey work simply through, and I'll call it a single manufacturer or 2 or 3 manufacturers of the product that I only have to have one contract with, is really the way this has to work. Buying 25 different systems and trying to bolt them together myself is not where anybody wants or should be. And therefore, what I do see is that over time, the number of people in specific marketplaces. So in standard vanilla mortgages, the Mortgage Brains, Iris, the 27 Tech will run a lot of that. There's areas like your firm as well, who are much more specialist in working areas where you've got really good technology that works in that specialist arena. There is nothing that works this way in the later life arena yet, and that will happen in due course, I have no doubt. But all of this will work in a way where it's much more end-to-end, not people coming in to interrupt the marketplace and injecting something that's a small part of the journey. They will get bought up and integrated because that's the only way this can work.
Yeah. And also you've got, obviously COVID has pushed back a lot of technology investment, I think, at the moment. So we've heard some lenders that we're going to maybe look at Q1 2021, putting things back now to 2023. So it is. And I
think the challenges they've got on a whole range of issues about systems is not getting less. And I think, and this is actually where the other part of this is, we do still need to worry about what some fairly nasty people around the dark web and people who are trying to breach data security are continually a problem for everybody. Whether they're scammers or just people who do it for fun, their ability to bring firms down and cause them significant challenges or just steal some data and force that firm to incur significant fines is horrible.
Yeah.
But we have to be really, really careful in the cyber area to make sure that we're cyber secure and safe, and also know how to have worked out how to deal with it if it happens. Because trying to work out what to do when it happens after it's happened isn't a great place to be. Having the plan in place to know exactly what you do if it does happen and how you rebuild systems very quickly is entirely where firms have to be. And knowing that they've got business partners who've got that capacity is essential.
Great. What are the issues on the horizon for the mortgage market generally?
I think the challenge is remain that this year is actually going to be a much better year than we thought it was. I'm not sure once we get through this very forced phase of Help to Buy into next March, stamp duty reductions into next March, maybe extended, don't know. What that means for Q2, Q3 next year, because until we can see how COVID plays out into 2021, and what we see property transactions levels are like, and what we see happens to employment more broadly across the UK, it's very hard to judge what a market will be. What is clear is that there's a very clear correlation between consumer confidence and house prices. House prices at the moment are rising probably at around 5 or 6% year on year. And that creates consumer confidence, in fact, and that feeds itself into a structure that's quite positive. If we get a downturn in terms of consumer confidence, then that becomes harder. But I think some positive numbers are the fact that the number of people who are taking mortgage payment deferral is down to 176,000 people. That's a lot. The real doomsayers were saying that there'd be 400,000 people stuck on there for a long time. It's down to 176,000. That's a much better number than most people ever thought. I think most of the people who are going to struggle with unemployment are not people who are property owners. The vast majority, I think, will be the renters or people who are still living with parents. And I think that's going to be a big issue for society, is how we get the young people back to work going forwards. So I don't see mortgage issues with mortgage payments as being as big as everybody expected. And that's going to be positive for the housing market as a whole. I think.
What about acceptance of those who have taken payment deferral, not mortgage payment holidays, but should be called deferments? But have you seen an increase in people declining those or looking at more investigative into the clients?
I think we're going to come back to a position where lenders ultimately have targets they want to meet. And therefore, whilst there's noise around this at the moment because they're worried it's an indicator of stress or issues, and therefore they're very paranoid about where they might be with affordability tests that the regulator might look at. As we go further on, and there's a better understanding, they've had those, but they've gone back into payment. So for every month that goes by where somebody's back in payment, then that, I think, cleans them up quite quickly. And for those that are in there long term, then yes, clearly they're going to be in a position there where they're a long way down in terms of payments and will become obvious quite quickly. So I think we're going to have this demarcation line of those people who are genuinely in trouble and those people who've been able to repair quite quickly. And we'll see that flowing through. And I think those who've repaired, and then if you've had 3 months of paying a mortgage, then I think the lender's going to accept that as absolutely fine.
Fair enough. And also, I mean, brokers at the moment are really putting in long hours to meet demand, to meet the challenges that we're up against on a day-to-day basis with even just submitting cases to lenders and so on. Is it sustainable? You mentioned obviously stamp duty at the end of March. Are we going to see a drop in transactions in April? All these things that are on the horizon at the moment. What's your thought? What's your views?
Well, I mean, the thing about property transactions is they have long lead times. The apt to offer is one thing we measure. Offer to completion is the other one that we don't measure. Well, we should measure because that's often when people get paid, and therefore knowing that gap is really critical. And everybody's telling me that offer to completion average time is going out quite significantly at the moment, and therefore the pipeline that's sitting in lenders and sitting in conveyancers is growing and becoming more and more unwieldy. And that's one of the reasons we're talking to Treasury and MHCLG about a need for this stamp duty holiday to be flexed, so that it's not a drop off 31st of March. That either we take that further out to June perhaps, or we find a way of saying those transactions which are agreed by a certain point in time can have the holiday, but we have longer to legally complete them, as happens in something like Help to Buy, where you have to have completed the transaction in February, but you've got till the end of March to complete the legal transaction. And things like that are really important. But we all know the lead times of these things are quite long, and making sure you've got a landing slot or a processing slot with a conveyancer is probably going to be more important than getting an appointment with a surveyor at the moment. So getting an agreement that you've got a conveyancer or solicitor who can definitely complete the transaction in time is going to be essential. And things like, people are going to be a lot more flexible about the costs of things like search waiver insurance. Because if we've got local authorities who are some are out 4, some are out as far as 16 weeks now in terms of responses to searches. Therefore, all of these things are part of the whole difficulty, and therefore finding ways around that are effective is as important as trying to deal with the issue itself.
It's also getting right down to the consumer right from day one, because they might instruct a solicitor who 12 weeks down the line you actually find out is not applicable to, or not approved by the lender, and then they have a joint cost effectively because they've already instructed one solicitor and now they've got to instruct the lender's solicitor as well.
Yeah, we're having some interesting debates with the home buying and selling group around this, where a lot of the solicitors, estate agents, are trying to encourage people into doing exactly what you say, get your house legally ready for sale, but you do have to do that through somebody who might not be on the right panel when you get to lender. You're absolutely right.
Yeah. The other problem we're having at the moment is obviously cladding. That's a major part of our industry, and the recognised qualifications with regards to actually can sign off these properties. And these can actually be new builds as well. We've had some recently where they've had the smallest part of cladding, but the whole property couldn't be signed off because I don't know if the exact figures are correct, but I got told there was 60 people could only sign off 1 million properties across the country or something. I don't know if that's right or wrong, but I understand it's a big problem at the moment. Have you come across the EW1S form problems at the moment?
Yeah, I mean, EWS ones are fundamentally an issue, and when they were first brought in for properties above 18 stories, they were absolutely in the right place and there were enough people to deal with the issue. We've had some interesting extensions to that, where some people have decided they want to take it into all flats, and then of course some other people want to take it to all properties. And the rationale behind this was, of course, to make sure that we didn't have combustible aluminium cladding on the outside of buildings that quickly took those into a space where effectively fire engine ladders couldn't get to the level of, and that was what was above 18 stories, because most fire brigades have the capacity to get up to that 17th floor level, but not past that. And that was the reason for the initial discussions and debate. What I can say is that I'm very aware that UK Finance and the Building Societies Association are in weekly dialogue now, with RICS in the room as well, with the insurers of the surveyors in the room, and the housing minister in the room, to try to break this logjam. Because there are two levels of logjam. One is, how do we get an effective definition of the properties that genuinely need an EWS1 and those which don't, i.e. a new build 2-story property in Milton Keynes does not need an EWS1. Let's not be stupid about this. The harl or the cladding on the outside of that building is not going to be the thing that causes the major problem. So we need to get back to a proper definition of what the property is. We then need a better definition of at what level it has to be done, and greater clarity about when that form can be used, and making sure that there aren't fraudulent ones in the marketplace as well, because we've already seen that happen as well. The second element is to actually deal with the fundamental thing that has not yet been resolved, which is, if the cladding had been taken off and replaced properly, you wouldn't need an EWS1.
Yeah.
And fundamentally still, there are far too many buildings where you are still fire marshals in 24-hour attendance, and the cladding's not been removed, and the government needs to get its head around this and get it sorted. And that's the pressure that's coming from the industry into government as well, because this is a national disgrace that this hasn't been sorted.
Just conscious of the time, just a couple of other things I want to ask you quickly. There are obviously other trade bodies, especially with regards to the short-term lending area, all after obviously all protecting brokers, clients, etc. Are you in constant dialogue with them? Are you getting closer to them since COVID?
Yeah, I mean, whether it's NECFB, FIBA, ASTL, and UK Finance, Business Association, IMLA, all of these are trade bodies. The Finance and Leasing Association, we have regular dialogue and meetings with all of them at various levels, sometimes just at an executive level, sometimes with members as well. And we're continually trying to work together to make sure that we share knowledge, understanding, best practice, and also coordinate our thinking so that when we do talk to regulators, we're coming with a consistent message across the industry, because we're never going to agree on everything. But on the 70–80% of things we are agreed on, let's be totally with one voice and lobby and campaign together, because that's essential. There's going to be stuff around the edges we don't agree on. You know, I'm not very happy with the way some lenders are dealing with increasing product transfer rates at the moment. I'm not very happy with the way they're dealing with service standards at the moment. But that's a row for them, not for the core of the stuff we fundamentally can agree on as things that are much more important. Well, these things are important, but we can genuinely achieve change together on. And that's therefore very much part of what I'm continually trying to do as part of the job, in order to just spread knowledge, understanding, and get the best outcome for brokers and consumers, because that's the key to it all, is making sure brokers can serve customers best.
Yeah, absolutely, 100%. And then just finally, what's your advice to brokers, A, for the rest of the year, and B, for 2021?
Well, what I would say is that we talked about it a little bit earlier, which is at the moment, things are really, really busy, and some brokers are working ridiculously long and hard hours. I would just say, be careful you don't reach burnout. Look after yourself and look after your family, because that's really, really important at this point. Because I want people to be here for tomorrow and the month after and the month after that, not in a position where they really struggle with all of that. The second element is that at the start of this pandemic, I thought Q3 and Q4 could financially be really difficult for brokers, and it's not turned out like that at all, in that we've got levels of transactions and busyness, which, as long as it all completes, everybody will have had actually a reasonably good year, in my view. So I think in any time where there's difficulty like this, I would say to any firm, if you're making decent money, put some away for next year, because next year might be tougher. We don't know what's around the corner. We don't know how difficult it's going to be. Therefore, put a little bit of money away for next year. I don't think next year will be cataclysmically bad, but I don't think it'll be a year bigger than this year, because I think we're still going to do about 240 billion of gross mortgage lending this year. And that's a huge number, given that we did 267 last year and we had so much time out. I still expect next year to probably be around the 230 billion number. So not significantly less, but enough just to take a bit of heat out of your broker's ability to earn. That takes about 10% of the broker market away. So we need to think about, it's not a growing market, but a static market. I'm going to think about being flexible. So there are lots of market opportunities that may be outside the mainstream, and everybody's life's going to be slightly more difficult. Therefore, being an expert in the complicated is going to be, I think, the challenge for everyone next year. You're alluding to it earlier in terms of how soon will those people who've taken payment deferment credit be repaired. And I think the challenge is good brokers knowing exactly which lenders will do what is exactly what the market is going to be about. Therefore, being informed, knowledgeable, and having the right contacts with the right business partners to be able to place complex business with lenders who are prepared to play is actually the fundamental of where people will make good money next year.
Brilliant bit of advice. Robert, thank you very much for your time. Really appreciate that. Really insightful, and I'm hoping that all of our broker audience will have found that useful.
Pleasure to talk to you, Dale, as ever.
Thank you. And in the meantime, if you're not a member of AMY, then please do look at AMY's website to become a member. It's very valuable, very useful, and like Robert has just gone through, really by fighting our battles is the bottom line, which right now we certainly don't have the time to do ourselves. So very worthwhile entity. In the meantime, thank you very much for watching this. We will do some more Impact Insights shortly. In the meantime, take care and stay well.